Taxing the rich. It's a topic that's, well, it's packed with paradoxes, huge numbers, and even bigger questions about what's fair. So in this explainer, we're going to break it all down, using our source material to walk us through how it all works.
Okay, so let's kick things off with this super famous quote from one of the richest people on the planet. And let's be honest, it's a head scratcher, right? When a billionaire says his secretary pays a higher tax rate than he does, it really makes you stop and wonder.
I mean, it just feels like it goes against everything we're taught about how taxes are supposed to work. So that's the big question we're going to dig into. How on earth is that possible?
And that question brings us right to what we can call the billionaire tax paradox. It's this really weird situation where the people with the most wealth don't always pay the highest tax rate. In fact, sometimes it's the lowest.
All right, let's take a look at this chart. It's based on some really interesting research from economists like Gabriel Zuckman. What you're seeing here is the total effective tax rate. So that's not just federal income tax, it's everything. Federal, state, local, the whole shebang. And you know what's wild? For most people, the system pretty much acts like a flat tax. But then, look way over on the right. See the top 400 wealthiest families? Their rate actually dips. It's not a ladder that just keeps going up and up. In fact, it gets even crazier. When you stop looking at income and start measuring the tax paid against their total wealth, that rate can just plummet. According to that same research, some billionaires today might pay as little as 0.2% of their total wealth in taxes. Let that sink in. That's the core of this paradox.
So you're probably asking, how does that even happen? And here's the key. This isn't about people breaking the law or illegal tax evasion. Nope. It's all about how our tax system is designed. See, it's not really about income, it's all about assets. Think of the tax code as having two totally different rule books. On one hand, you've got income from a job, your wages, your salary. That gets taxed automatically, right out of your paycheck, with federal rates climbing up to 37%. But on the other hand, you have wealth, money made from assets like stocks or real estate. That's a different game. It only gets taxed when you sell it, and even then, the top rate is way lower, just 20%. And let's face it, the super rich aren't getting most of their money from a regular paycheck. This leads us to a super important concept: unrealized gains. Just think about it for a second. Let's say your stock portfolio doubles in value. You are, without a doubt, a lot richer. But, and this is the important part, until you actually sell those stocks, none of that gain counts as taxable income. You can build a massive fortune on paper, and your tax bill for the year, it might barely even notice. Okay, so this whole system opens the door for a strategy that our sources call buy, borrow, die. It sounds a bit dramatic, but it's actually pretty simple and incredibly powerful. First, you buy assets that are going to grow in value over time. Stocks, real estate, you name it. Step 2, you borrow. Instead of selling those assets and triggering a big tax bill, you just take out low-interest loans against them to get cash for your living expenses. And the final step? You die. Yep. When you pass away, those assets go to your heirs, and a massive loophole called the stepped-up basis can literally erase the capital gains taxes on a lifetime of growth. Just gone. So what's the end result of a system like this? One that taxes work so much more heavily than it taxes wealth? Well, you get what many describe as an exploding wealth gap. And to really get a sense of the scale here, just look at this number. The top 10% of Americans, they own about 75% of all the household wealth in the entire country. And this concentration of wealth, it's not slowing down. It's actually set to grow. We're talking about an estimated $30 trillion expected to be passed down to the next generation in the coming decades. It's creating what some are calling modern American dynasties. And as that economist we mentioned earlier, Gabriel Zuckman, puts it, this really isn't just about the money. He says, wealth is power. An extreme concentration of wealth means an extreme concentration of power. And that, of course, raises some really big questions about its influence on our politics, on policy, and on democracy itself. Okay, so this widening gap has, unsurprisingly, kicked off a huge debate. And with that debate come a lot of different ideas for how to address it. So let's explore 3 of the main proposals that come up in the source material. All right, idea number 1, a wealth tax. Now, this is different from an income tax. It's not a tax on what you earn each year. It's an annual tax on what you own, your total net worth. But, and this is crucial, these proposals only target wealth above a really, really high threshold.
So for example, one well-known proposal would put a 2% annual tax on any wealth over $50 million dollars and a 3% tax on wealth over $1 billion. Just to be clear, anything below $50 million, totally untouched. We're talking about a tax that would only apply to about 75,000 households in the entire United States, a tiny fraction of the population. Okay, idea number 2 takes a different approach. Instead of adding a whole new tax, this one focuses on reforming the system we already have. Basically, the goal is to close those specific loopholes that allow so much wealth to avoid being taxed in the first place. And two of the biggest ones you hear about are, first, that stepped-up basis we talked about, the one that wipes out capital gains when you die, and second, something called the carried interest loophole, which basically lets some super successful investment managers pay a much lower tax rate on their income. And that brings us to the third idea, which is maybe the most straightforward of them all. Just make the tax rates equal. The proposal is simple. Tax the money you make from selling assets at the exact same rate as the money you make from working a job. Get rid of that special lower rate for capital gains altogether. Of course, none of these ideas are simple to implement, and every single one of them has a ton of debate around it. So let's switch gears and look at the pushback. What are the common arguments against these proposals, and what are the counterpoints we find in the sources? First up, the big legal question. Is a wealth tax even constitutional? So the argument against it says, hey, the Constitution forbids a direct tax on property. But the counter-argument you'll hear is, well, what about property taxes? We've had a tax on the main form of wealth for the middle class, their homes, for a very, very long time. Next, what about the economy? A really common argument is that if you tax the rich more, they'll have less money to invest, and that'll slow down the whole economy. You've probably heard this one before. But the counterpoint to that often points to history. The argument goes that the U.S. has had periods of really strong economic growth back when the top tax rates were way, way higher than they are today. We're talking 70, even 90%. And finally, there's the practical question. Let's say you pass one of these taxes. Won't the wealthy just hire a bunch of smart people to find a way around it? Opponents say it's just not workable. But on the other side, research from proponents suggests that even if you account for some of that avoidance, a 2% wealth tax could still bring in an estimated $2.75 trillion over a decade. That's a huge number. And all of this, it really brings us to the fundamental question at the heart of this entire debate. Is a system where the wealthiest people can pay a lower effective tax rate than many others a bug, something that's broken and needs to be fixed? Or is it a feature, something designed on purpose to encourage investment and risk-taking? Ultimately, it forces us all to ask a much bigger question. In the kind of complex global economy we have today, what does fairness actually look like?